My name is Takuya Machida, and from February I have taken over the role of Executive Officer, Head of Metropolitan Division from Mr. Araki, and I run the Japan Metropolitan Fund Investment Corporation. I will be presenting JMF's earnings for the 46th period ending February 28, 2025. Page 2 covers the overview of our current growth strategy. This was used in our previous period's earnings presentation materials, but we are reusing it here to emphasize our strong commitment to continue our strategy focused on internal growth and return of gains on disposal. Page 3 shows the trajectory of our DPU and NAV per unit. The DPU in period 46 grew 22% from the previous period to hit 2,808 yen, reaching the highest level ever. Period 47 is expected to hit 2,770 yen, and period 48 is expected to hit new highs at 2,850 yen. By realizing our growth strategy, we are able to greatly increase the DPU levels and maintain such high levels while we continue to work hard to achieve even better results from period 49 onwards. Also, the NAV per unit at the end of period 46 was the highest level ever, reaching 120,800 yen. This was because the appraisal value increased due to the increase of cash flow from our existing properties and the unrealized gains from the properties we acquired through the PO we did in period 46. Therefore, thanks to our DPU and NAV growing well, the calculated annual total returns for period 46 was 11.8%. Page 4 talks about the overview of our internal growth, which is the main driver of our growth strategy. We expect our existing portfolio's average annual NOI growth rate to be 3% for the 3 years starting from 2 years ago to next year. Urban retail properties and offices are driving this growth. Even in the current environment, we have many properties that have potential for further internal growth. We see market rents are continuing to increase, and as inflation rises, we see an increase of revenue-based rent due to an increase of sales in our retail properties. Therefore, we feel there is good potential for further upside. We will continue to aim for even higher NOI growth. Page 5 talks about another driver of our growth strategy, which is how we are using our proceeds on disposal and gains on disposal. We are currently considering disposing of assets of around 60 billion yen, and the negotiations are proceeding well. As each property is quite different, we are not considering doing a bulk sale, but instead we want to sell each property separately, with the goal of maximizing the selling price for each property. If successful, we expect to receive a large amount of gains on disposal. By using this entire amount to 100% give back to the shareholders, this would allow us to achieve even higher levels of distributions and hopefully allow us to maintain and further grow the level of distributions in the medium term. Regarding the proceeds from disposal, we will continue our strategy of either acquiring new properties or doing buybacks, and we will make the appropriate decision based on which option we feel would lead to a higher DPU and NAV. Also, our current acquisition pipeline is around 90 billion yen, and the candidates in the pipeline have an NOI yield higher than the implied cap rate, an NOI yield after depreciation higher than the portfolio average, and unrealized gains of 20% or higher. Page 6 shows our strategy for gains on disposal. We already have around 300 yen worth of gains on disposal for up to period 49. However, as previously mentioned, we are working on disposing of an additional 60 billion yen of assets, which means that we want to continue to have over 300 yen worth of gains on disposal given back to the shareholders each period. We are even getting a lot of initial offers for properties which are not currently under negotiation. Thus, we would like to leverage this information to allow us to continue to sell off our assets at a high price. Page 7. As we work on achieving our growth strategy, the relative position of our unit price is improving. However, unfortunately, our unit price continues to trade below the NAV per unit. Therefore, we feel we must act urgently to further improve our unit price. Both JMF and IIF have implemented a strategy focused on improving total returns. The total return is made up of the DO NAV plus the NAV growth rate. The DO NAV is the DPU divided by the NAV per unit. Our strategy is to increase the DO NAV back to the level the market expects for returns, and this should bring the unit price back to the level of NAV per unit. Along with that, we want our NAV growth rate to be reflected in our unit price, and thus the unit price should move above 1 times NAV. Given that JMF is aiming for a DO NAV level of 5%, And with the current NAV per unit at 120,000 yen, we want to improve the DPU to be around 3,000 yen. As previously mentioned, for each period, our strategy is to have over 300 yen of distributions coming from gains on disposal, so we need to have the remaining 2,700 yen coming from internal growth. Our current DPU level, excluding any gains on disposal, is around 2,400 yen, so we need to improve this level by around 300 yen. In addition, the midterm negative impact to DPU from higher interest rates, if the current interest rate environment continues, is around 150 yen per period. Therefore, given all of this, we need to improve the DPU by 450 yen, which excludes any gains on disposal. This amount is equivalent to 3 billion yen and would be an NOI of 10%. Thus, we aim to improve the NOI of our current portfolio to over 10% in the medium term, which means that we must achieve internal growth. Also, in order to increase the probability of achieving a DPU of 3,000 yen, we need to continue to do asset replacement and external growth through using our excess LTV capacity. Next, I will briefly explain period 46 results and period 47 and 48's forecast using pages 8, 9, and 10. For period 46, our operating revenue, operating income, and net income all exceeded the forecast we announced on October 21, 2024. The EPU overshot the forecast by 1.8%, hitting 2,752 yen, and the DPU overshot the forecast by 1%, hitting 2,808 yen. The main reasons were the impact from the newly acquired properties and the huge internal growth achieved from the existing properties and the properties we recently acquired through last year's PO. Within the newly acquired properties through the PO, the Unimo Chihara-dai property showed a large growth in the NOI, even though it was acquired only 6 months ago. Next, the forecast for period 47. Compared to the original forecast announced on October 21, 2024, the new forecast has operating revenue, operating income, and net income more than 2% higher. The EPU is 2.6% higher at 2,695 yen, and the DPU is also 2.6% higher at 2,770 yen. The main drivers are internal growth from the existing properties, such as being able to raise the rents for the urban retail properties, higher revenue-based rent due to our tenants enjoying growth in their sales, an increase of revenue from card fees, etc., increasing rents when our office tenants renew their contracts, and our leasing activities being successful, thus allowing us to fill up our properties. Also, we have been able to achieve strong internal growth, which more than offsets the increase of borrowing costs due to the expectation of higher interest rates in this current environment. We are announcing for the first time the forecast for period 48. And here as well, we are expecting the operating revenue, operating income, and net income for period 48 to be higher than period 47. We are expecting EPU to be 2.9% higher at 2,772 yen, and DPU to also be 2.9% higher at 2,850 yen. Both would be the highest level ever. For period 48, we are expecting an increase of gains on disposal along with the same type of strong internal growth from our existing properties that we are expecting in period 47. This positive growth is expected to be higher than the increasing debt cost for our existing properties. For period 48 refinancing, we have conservatively forecast a buffer of around 80 basis points higher than the current interest rates, which means that if the actual interest rates increase less than the buffer, this would be an additional upside. Along with that, for the Twin 21 property and the JMF Building's Ueno 01 property, we are expecting a downtime impact of 46 yen. However, the main reason is the impact of free rent for the Twin 21 property due to retenanting. However, once that free rent period ends, this impact will go away. For the JMF Building Ueno 01 property as well, given the strong office leasing environment we're in, there is a good possibility we can further improve the NOI of this property through retenanting. Thus, based on how the leasing activities go, there is further upside potential here as well. This concludes my explanation on period 46 results and period 47 and 48's forecast. I will briefly highlight the important points on page 13 onwards. Page 13. The point I want to emphasize regarding internal growth is that our portfolio strength is that we have a lot of urban retail properties, which are mainly fixed-term, short-term contracts, which have revenue-based rent clauses, and Osaka office properties, where there is a large rent gap. These are the types of properties where you can achieve internal growth. Page 14 talks about the details on the results of our internal growth activities. For the contract renewals during period 46, rent went up on average 7.8% for the overall portfolio, and the DPU impact for the period was 73 yen. For period 46, we especially saw growth in the retail property category, and this was driven by the increase of rents when renewing contracts for high street properties and the impact of the renewal activities for our Mozo Wonder City property. The details are highlighted on page 15. For retail properties, we are seeing rents go up around 3% annually. The rise in market rents and the growth of inbound tourism are helping to accelerate this growth. Page 16. What's especially noteworthy is that because our tenants are seeing strong growth in their sales, revenue-based rent has seen a strong annual growth on average of 4.2% from period 43 to period 48. Around 60% of our retail tenants have a revenue-based rent clause, so we can expect our revenue-based rent to continue to grow as our tenants' revenue grows. Page 17 shows several examples of this. Let me touch on the Unimo Chihara-dai property, which was acquired in last year's PO. We talked about the potential upside for the property at the time we decided to acquire it, but we were able to quickly achieve the upside due to the following reasons. We were able to lower costs through revising our sales promotion costs and the electricity contracts, and we were able to grow the sales of our tenants through our operational know-how, which led to higher revenue-based rent for us. These activities achieved an additional annual NOI of 150 million yen, and we expect the NOI yield to be 0.2% better than what we were originally expecting at the time of acquisition. Also, the appraisal value went up 900 million yen, or 2.6% in just 6 months. Page 18. Regarding our office properties, we are able to continue to raise the rents for our Osaka offices, where the contracts are coming up for renewal, and the rent levels are growing on average over 6% annually. Lately, we were able to greatly increase the rent when we leased up the JYO Tower, which is one of the twin 21 towers, after the single-tenant Panasonic left. For the JMF building Osaka Fukushima 02 property as well, which was acquired in last year's PO, we were able to raise the rent over 17% compared to the previous tenant and over 10% compared to the appraisal value with no downtime incurred. Thus, we are able to continue to raise the rents. Page 19. Rent for residential properties is continuing to go up, and for period 46, rent increased 5.2% at tenant replacement and increased 2.5% at contract renewal. Thus, both are showing strong growth. For hotels as well, at the Omo 3 Tokyo Akasaka property, which has both fixed rent and revenue-based rent, the revenue-based rent greatly grew to be 2 times the rent of period 43, which was 1 year after opening. For Dormy Inn Hakata Gion, which is a fixed rent contract, we were able to achieve a large increase of rent at the time of contract renewal, and the appraisal value grew over 60%. Page 20. JMF has potential for further internal growth in the long term from period 49 onwards. This includes such properties as G Building Shinsaibachi 02 and 03 and the JMF Building Midosuji 01, which had their contracts renewed and were retenanted during COVID. Also, the Unimo Chihara-dai property with the upside expected due to renewal activities, and the expected upside for properties such as the Adio Otori, which is seeing strong sales and will be having the 20-year fixed-term contract coming to an end. Also, for the JMF Building Okinawa Kokusai Dori 01 property, where we are participating in its development, the leasing activities are going well, and the expected NOI yield is expected to grow from 4.5% to around 5%, so we can expect this will also be contributing to our performance in the future. Page 22 talks about our strategy on using the gains on disposal to give back to the shareholders. As part of our portfolio reshuffling strategy after our merger, JMF has continued to capture gains on disposal and given them back to the shareholders, with the total amount given back being 13 billion yen. On the other hand, from last year, we have started strategically disposing of properties for the express purpose of obtaining gains on disposal. We have already sold the Ito Yokado Tsunashima property and the Konami Sports Club Kyobashi property at a price of around double the appraisal value, thus giving us around 8.7 billion yen of gains on disposal from these 2 properties. The details on the latest portfolio reshuffling are shown on page 23 and page 24. Page 26, our finances. Given the current funding environment, we are borrowing using mainly fixed interest rate loans. At the end of period 46, our fixed interest ratio was 93.4%, and our long-term borrowing ratio was 96.5%. For period 47 and 48, we are planning to refinance using mainly long-term fixed interest rate debt. Also, given the probability of further rate hikes in the upcoming 2 periods, we have baked into our forecast a buffer of an additional 50 basis points for period 47 and an additional 80 basis points for period 48 compared to the latest base interest rates. Page 27. Regarding our sustainability initiatives, from an external evaluation, we were able to achieve the highest score of A for the first time ever in the CDP Climate Change Program. Lastly, let me once again summarize JMF's strategy. The business model for J-REITs is extremely simple in that you have basically 3 jobs: to buy properties, to manage the properties, and then to sell the properties. Therefore, what differentiates a good REIT is how cheaply they can buy a property, how much they can improve the NOI of that property, and how much money they can make from selling that property. In the deflationary environment we experienced up until recently, debt costs tended to be low due to falling interest rates, and unit prices naturally tended to rise thanks to an improved NAV due to lowered cap rates. Thus, you could buy properties at the market price and simply have long-term lease contracts and do little else, and you could be fine. However, in the current inflationary environment, which is the exact opposite of the past, each J-REIT has to acquire properties based on their investment perspective. They must aggressively improve NOI, they must sell their properties at a high price and give those gains on disposal back to the shareholders, and they must have a high level of operational excellence if they want to succeed. KJRM is in charge of doing the asset management for JMF, and we have the operational excellence in each of these 3 main business domains: selling properties, increasing NOI, and acquiring properties. When it comes to asset disposal, KJRM Holdings has an investment team of over 20 members, and each member has a diverse network of contacts within the industry. We use this network to try to sell each property at a high price. When it comes to improving NOI, in the past we compiled a bottom-up portfolio plan outlining how much more we can grow the NOI based on each individual property. However, currently we are working hard to transform our operations in order to plan and execute how to increase the NOI to be 10% or higher. When it comes to property acquisition, when we had low interest rates, the income players were strong. However, now with higher interest rates, the opportunistic players are strong. Such players are not that concerned about dividend returns, but are aiming for capital gains. And as they are expecting NOI to improve with inflation, they are expecting this will lead to higher exit prices. Thus, they continue to be bullish on real estate investment, and that is why it is said that the real estate prices won't drop even within a higher interest rate environment. In such an environment, our investment perspective is that it will be difficult to acquire properties from the market, so our main acquisition channel will be CRE carve-out deals with our sponsor KKR. When no such deals exist, or if such potential deals don't meet our criteria, we will do buybacks as a means of investment. With this strategy, we want to maximize the returns for our investors. In other words, we want to maximize the income gains through distributions, and we want to maximize the capital gains through increasing the unit price. This concludes my presentation.